Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Understanding Cash Flow Basics. Understanding cash flow basics is pivotal for mastering business strategy and cash flow management. Cash flow refers to the net amount of cash being transferred into and out of a business, reflecting the company's liquidity and overall financial health. It is essentially the heartbeat of a business, dictating its ability to sustain operations, invest in future growth, and weather financial storms. The primary components of cash flow include operating activities, investing activities, and financing activities, each playing a crucial role in the comprehensive understanding of cash flow management. Operating activities are the core transactions and events that determine net income. These encompass revenues from sales, payments to suppliers, wages, and other operational expenses. Essentially, operating cash flow indicates whether a company can generate sufficient positive cash flow to maintain and grow operations without the need for external financing. A healthy operating cash flow is a key indicator of a company's ability to sustain itself in the long term. For instance, Apple Inc., in its 2020 financial statements, reported an operating cash flow of $80.67 billion, a testament to its robust business model and operational efficiency. Investing activities, on the other hand, include the acquisition and disposal of long-term assets and other investments not included in cash equivalents. These are crucial for a business's growth and long-term stability. For example, a company might invest in new machinery, real estate, or other businesses. While these activities might initially result in a cash outflow, they are essential for future revenue generation. A notable instance is Amazon's investment in logistics and technology, which has significantly enhanced its operational capabilities and market position. Financing activities entail the inflow and outflow of cash related to transactions with the business's owners and creditors. This includes issuing and repurchasing stocks, dividend payments, and borrowing and repaying bank loans. For instance, when Tesla Inc. raised $5 billion through equity issuance in 2020, it strengthened its balance sheet, allowing for greater flexibility in its ambitious expansion plans. This example underscores how financing activities can provide the necessary capital for strategic initiatives and growth. Understanding the interplay between these three components is critical for effective cash flow management. A business might have strong operating cash flows, but could still face liquidity issues if it heavily invests in long-term assets or has significant debt repayments. Conversely, a company with negative operating cash flows might sustain itself temporarily through strategic financing, but cannot do so indefinitely. This dynamic necessitates a holistic view of cash flow, emphasizing the need for detailed financial planning and analysis. Effective cash flow management requires vigilant monitoring and forecasting. By regularly analyzing cash flow statements, businesses can identify potential shortfalls and take preemptive measures. For instance, during the 2008 financial crisis, many companies faced severe liquidity issues due to their inability to foresee the extent of the economic downturn. Those that survived often did so by quickly adjusting their cash flow strategies, securing additional financing, or cutting non-essential expenses. Moreover, cash flow forecasting is a critical tool for anticipating future financial needs and planning accordingly. Accurate forecasts allow businesses to prepare for periods of cash shortages or surpluses, enabling them to make informed decisions about investments, cost-cutting measures, or financing needs. Techniques such as rolling forecasts, where predictions are continually updated based on the latest data, can provide a more dynamic and responsive approach to cash flow management. A study by PwC highlighted that companies with robust cash flow forecasting processes were better positioned to navigate financial uncertainties and sustain their operations during economic downturns. Cash flow management also involves optimizing working capital. which includes managing receivables, payables, and inventory. Efficient working capital management ensures that a company maintains sufficient liquidity to meet its short-term obligations while maximizing its operational efficiency. For instance, extending the payment terms with suppliers or accelerating the collection of receivables can improve cash flow without impacting the company's operations. Walmart's effective inventory management system is a prime example of how optimizing working capital can enhance cash flow. By maintaining low inventory levels and quickly replenishing stock based on demand, Walmart minimizes the cash tied up in inventory, thereby improving its overall cash flow. Another critical aspect of cash flow management is understanding the impact of external factors such as market conditions, interest rates, and economic policies on a company's cash flow. For instance, changes in interest rates can affect a company's financing costs, while economic policies can influence consumer spending and business investment. During periods of economic uncertainty, businesses need to be particularly vigilant about their cash flow, as external factors can significantly impact their liquidity and financial stability. The COVID-19 pandemic is a recent example where many businesses faced unprecedented cash flow challenges due to sudden disruptions in demand and supply chains. Companies that quickly adapted their cash flow strategies, such as by renegotiating payment terms or securing emergency financing, were better able to withstand the financial impact of the crisis. In conclusion, understanding cash flow basics is fundamental to mastering business strategy and cash flow management. By comprehensively analyzing and managing operating, investing, and financing activities, businesses can ensure their long-term sustainability and growth. Effective cash flow management requires continuous monitoring, accurate forecasting, and strategic decision-making to navigate financial uncertainties and optimize working capital. Real-world examples, such as those of Apple, Amazon, Tesla, Walmart, and the responses to the COVID-19 pandemic, highlight the critical importance of cash flow management in maintaining a company's financial health and resilience. As businesses continue to navigate an ever-changing economic landscape, a deep understanding of cash flow basics will remain a cornerstone of successful financial management and strategic planning. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.